Hi guys, we're back for 14.5 on your own. So we're going to talk about the depreciation adjustments and how they're planned and recorded on a worksheet. So I want to go through the PowerPoint here first, and then we'll look at the chapter material, then we'll go through the ACCIII. So we've got some new terms that you're going to need to be familiar with here. First thing is current assets. These are assets that are consumed within a year or less. And then we have plant assets. Those are considered to be durable assets that are used up for periods longer than a year. So this becomes important when we are looking at doing our balance sheet for our merchandising corporation. So we're going to have separate sections on the balance sheet where we record the current asset and plan assets under the assets section. So we're just building a different section here, but we got to keep it in mind. Okay, depreciation expense. Now, we have to depreciate the value of any asset. So just like we do with prepaid insurance, we consume it over the course of the year, and we have to make an expense entry as well as an asset entry to reduce the value because we're using it up. Same thing applies to both plant and current assets. Okay, now here's this concept, and I'm probably gonna belabor this farther than you need to, but I want to reinforce it because my accounting students stumble over this every time I teach this lesson. So the salvage value is the value of which the asset can never depreciate below, also called scrap value. So thinking about the metal green filing cabinet in front of my classroom. That thing's old, it's tough, it's probably been in my classroom at least since day one. It may have been moved from another building. It's steel, it's heavy, it's durable, it's tough, and it's probably going to outlast me. So when it does reach the end of its life cycle, though, the steel that it's made from has value. So that file cabinet will never drop below the value of the raw products that can be reclaimed. Okay. Straight line method of depreciation. What this means is that through the life cycle of the product, you reduce the value over the number of years equally. So if the product is worth $500 and it has a 5-year life cycle and no salvage value, you're going to reduce the value $100 per year. But what you're also going to want to do is record how long that asset has been in service and how much it has depreciated. So if we're doing the depreciation for year 3, we will have already recorded depreciation at $200 from prior years. And at the end of year 3, like we're doing here on our worksheet, we are going to depreciate it an additional $100. Okay? So, but what if it does have salvage value? Well, if it does have salvage value, there's a book value of that asset that it can never go below. So let's say we got a $1,000 asset depreciated over 5 years. Do you depreciate it $200 a year? No, you do not. What's the salvage value? Maybe that salvage value is $100. So at the end of the 5-year life cycle, it's still worth $100. So you're only depreciating for a sum of $900 over those 5 years. Okay. So what we have to do here is take a look at the original cost. So if the original cost is $1,250, the first thing we do before we do any depreciation is record the salvage value. The value of the item can never go below the salvage value or the scrap value. If when you're looking at your worksheet, you drop below the salvage value, you've done something wrong. You need to go back and fix it. Okay? So we then estimate what our total depreciation expense can be over the life cycle, which is $1,000. All right? So our estimated total depreciation is then divided by the useful life cycle of the product. So a car is a great example of this. Cars are depreciated over 5 years on your books. They're a durable plan asset. If you get more than 5 years out of them, great. But the IRS considers 5 years to be the useful life. Technology is a little different. IRS used to let you depreciate the vehicle Used to let you depreciate the computer over 3 years. Well, that changed because technology changes every 18 months. It wasn't realistic. And you get the most utility out of your technology during the first year. So what they're letting you do now is when you buy new technology, you can depreciate the full value on your taxes during that first year. And remember, this is an expense. This comes off your bottom line. This is just like you're spending money. So you've acquired the assets and you've depreciated. So when you're doing your end of year, your taxation, this reduces your tax liability. So you're going to want to do this because this is classified as an expense. So how does it work? Well, okay. So we take a look at our accumulated depreciation here. We've done it for 2 years already, and we're going to record the third. So we look at our prior year's accumulated depreciation. It's showing up on our worksheet. I'll show you that in a second. And then we make the adjustment in the credit column to reduce the value on the asset, and then we go down and we record the $200 on the expense side of the worksheet. So our new accumulated depreciation beginning the fourth year is $600. So we are cleaning up here on our problem year 3. So, but remember, original cost was $1,250, not $1,000. So even though our accumulated depreciation here is $600, the ending book value of the asset is still $650. Why? Because it can never drop below $250. All right. And here's what the entries look like. So we have the total value of all of our office equipment entered here. You can itemize it if you want. You're going to have schedules, though, that record each individual item where you record your accumulated depreciation. Don't worry about it. You record the sum. Okay. And then here's your accumulated depreciation of all your office equipment from prior years. So what we are doing is we are reducing the value of all of our office equipment by this amount for this fiscal year. And then we go do the same thing with our store equipment. So this is our accumulated depreciation from our prior year's total. Then we make an entry for this year, and then we make an entry in the corresponding expense accounts. Okay, so far so good. So let's go back here, and I want to go back and encourage you strongly to read this in detail, especially this section here where you've got the original cost, estimated salvage value, estimated useful life, and book value. You got 2 factors affecting physical depreciation and functional depreciation. Okay, how long is it going to last? How long is it before it's going to be obsolete? And then, well, how hard are you using it? Does it wear out through normal use? If it does, well, if it's wearing out before the end of its estimated life cycle, 2 things are happening. Either you're buying an inferior product or you're working it too hard. So these are things that managers need to consider. Okay, so again, depreciation expense. We've got 2 classes of asset, current, and plant. We need to depreciate all the plant. So we're looking at store equipment, and we're looking at office equipment as well. So again, they use display cases here to help you keep that straight. Now, here's the math on it. We're going to use what's called straight line depreciation, which means that the value of the asset declines by an equal amount over its life cycle. I'll teach you, if anybody, I think River's the only one going to be back next year for this, but I'll teach you some other methods. There's double declining methods. There's the method where you depreciated at 2.5 times its value. So by the end of the 3rd year, it's fully depreciated. Again, that's the way tech used to be depreciated. Maybe it's your factory. Maybe that's going to last 100 years. So, okay. We've also got other methods for tracking inventory, like last in, first out, and first in, first out. So how you track your inventory also affects what method you use to depreciate. Just keep it in mind. But this is a very common way, and this is the easy way. So what we have here is original cost minus the salvage value equals the amount you are able to depreciate. Again, you cannot depreciate the salvage value. If you have salvage value, you have to record it. The asset can never drop below that. Think recycling. Your steel and aluminum cans, they've got value. You put them in recycling, they're picked up, they're remanufactured into new aluminum and steel cans. Okay, so our amount of total depreciation here is calculated right off the bat, and then we divide that by the number of the estimated life cycle in years to get an equal amount of depreciation per year. And from that, it's just a matter of plugging in the numbers. Okay, but again, here's what's tricky. Don't forget about the salvage value if it exists when you're calculating the book value of the asset. All right, so here's what the math looks like. And again, make sure F and G, we got F and G in our adjustments. We're starting to get a list, all right? And this is why I fuss at you guys about making sure you've got your alphabetical character next to the number, because you're going to need to go back and look at this in chapter 15 and 16 especially. And it's going to make this stuff a lot easier to locate because it's out of sequence here down at the bottom. So make sure you've got your alphabetical characters here. Okay, so accumulated depreciation is a contra account to the asset account. So it has a normal balance of credit. Keep that in mind. Here's the analysis with the T accounts. So you're reducing the value of the assets. Okay, and you have to record the additional depreciation in the adjustment column. Okay, and it just adds to, and you keep a running total. Your running total at the end of the year, which is the amount in the credit column and the trial balance column plus the amount in the adjustment column, is what you carry over to the balance sheet side and what you carry over to the income statement side. Well, the expense anyway. So let's do it. Oops. Great. Okay, so here's our problem. We have a computer printer. Okay, it costs $1,600. Our salvage value is $100, so we immediately record that as a salvage value. Life cycle is 5 years, so 1,500, not 1,600. 1,500 divided by 5 is 300 per year. So let me go into Apply, and hopefully it hasn't kicked me out. Okay, so here's what we're going to do here. Original cost, 1,600. Estimated salvage value, 100. Total depreciation, 1,500. Divided by 5 equals 300. Okay. All right. So, original cost. All right. That's for our first one. All right. So, everybody with me so far? Right, now, what we're going to do, we're going to go back up here, and we're going to look at our office equipment. I'm going to go back to the problem just to make sure that I'm telling you guys the right thing. Pull it up. Okay. So we then have to calculate the book value of the printer at the end of its second year of service. So we go down here, book value of the printer at the end of its second year. So 1,600. Depreciation year 1. Depreciation year 2. Okay. They're worth $1,000. Right? 600. And so it's still worth $1,000. Okay. Remember, 1,600 here, not 1,500. Right? So it's still going to be worth $100 at the end. All right, so we're going to depreciate it for $900 more, not $1,000. So let's go up here and make our entries. Make sure you put it's a G here. Let me look. Okay. So I'm going to go back to the problem. Calculate depreciation expense. Coastal Aquatics determined the total depreciation expense of office equipment 6120. This is really easy. So all you're going to do, plug in 6120 here. Okay. Go down to your store depreciation. Okay. 6120. It's out of sequence. Be careful. Be careful. All right. So that's halfway done. Let's go back. All right. And then store equipment is 5,060. So then what we do is we enter 5,060 here. And then we go find our store equipment down here. Whoops. Boy, I did it backwards, didn't I? And 56, yeah, I think is what it was. Okay. So just double check to make sure I've shown you guys the proper way to do it. Yep. So, and make sure you got your F here and your G here. And once you've done that, you've done it right. So I'm going to turn you loose on this, and these are the three I want you to get done. So submit the completed worksheet to me with 14.3, 14.4, and 14.5 to me. We're going to do a Zoom on Tuesday at 3 o'clock. I'll schedule it and send out a remind for anybody who wants some help. All right. See you then. You've got my remind information. You can always contact me through that.